The banking industry is in a cusp of change right now, isn't it? Banks have not innovated for several decades, and suddenly there's a competition from fintechs. And now banks have to compete with fintechs on one side, and they have to scale up and get more customers on the other side. And it's a struggle for banks in terms of profitability, getting new customers and improving the customer service. With all that in mind, we are definitely seeing a change in the way the banking industry is structured, the business models around the industry. And that's what we have looked at in the report. So we see that a whole kind of deregulation and utility kind of models are emerging in banking. And it's a very, very interesting change happening right now as we speak. And the report that we have done at Burnmark in partnership with Saxo Banking Circle looks exactly at those kind of models emerging in the market. So the utilities, it's a very, very interesting term, because what comes to your mind is you opening a tap, getting your water. You don't care who is the supplier of the water or the distributor or who manufactures the water for you. All you care about as a customer is opening the tap and making sure it comes at the right time, in the right pressure, right? And it's the same with any industry we look at it, the telecom industry, the electricity, the trains. It's about service and the experience at the end of the day. You don't care about the whole infrastructure behind it. And that's exactly what customers are demanding at the moment from every industry we look at. We can think of several other examples where the railway infrastructure is used by several players who focus on the customer experience and the brand and the timetables, and less on the actual rail network infrastructure. And the same with post offices being used for delivery and parcel supply purposes as well. So if you look at all of these industries, it was necessary for them to evolve and innovate quickly and offer new business models to their customers. And banking is lagging behind that today because it was heavily regulated in the past. But that is changing now with fintech coming in. And we will see more and more banks wanting to focus on their core competencies and their competitive advantages, and less on owning the customer end to end. The whole fintech industry has emerged since 2012 or so. And the impact of that industry in just 6 years has been absolutely phenomenal. Now, banks have had to completely rethink their business models and the way they reach out to the customers and their customer acquisition strategies. And with challenger banks coming into the UK as well, it's become a much more difficult game. So you need to have the right kind of front-end experience. The customer acquisition cost still has to be fairly low to be profitable. And you need to service your high-value customers as well as your new set of possibly low-value customers at the same time. So you're looking to use technology to drive profitability in ways we haven't seen before. We are talking about technologies like blockchain and AI giving fundamental competitive advantages to these kind of banks. Now, on the other hand, there are banks that say, okay, customer ownership is very, very difficult. So let's not do that. Let's focus instead on the regulatory infrastructure that we can offer. So let's find efficiencies and find the advantages and core competencies of what we do really well, and then outsource everything else. And that's a perfectly good model as well. So the front end then lies with the customer owners. And there are some banks who are doing that already in the US. And they focus then on the onboarding process and then subsequent servicing of those customers. So that's a perfectly valid model as well. Now, what will happen when this happens is things like correspondent banking networks today are extremely inefficient. They are extremely expensive for the SMEs, the merchants, as well as large corporates to use. And the individual customers, of course, they are moving away into fintechs for these kind of foreign exchange transfers now. And these kind of things will get increasingly outsourced to players who have the efficiencies and the strengths of network that banks don't have today. One of the things we noticed in our study is that the large banks always have certain strengths. either with a large scale of customers or with a large infrastructure in place. Now, the fintechs have a huge advantage themselves with very agile play and being able to launch new products very quickly in the market. But who is really struggling here are the tier 2, tier 3 banks, the smaller banks, the community banks in the US, the cooperative banks in the UK. And these banks are really struggling to find efficiency and an effective way of being profitable. So really, my heart goes out to these guys because it is very, very difficult in today's market with competition from fintechs and competition from large banks to survive and still be profitable. The report looks at 5 factors, which are cost, time, innovation, geographic expansion, and relationship of customers. And the most important aspect here is fees. The cost of getting into a network, using the correspondent banking network, is extremely high. So what's happening today is that the network of correspondent banks is getting increasingly difficult to maintain and expensive, and the cost is now passed on to the smaller banks and the smaller SMEs and the individual customers. Which is a really, really difficult situation for them to be in, because SMEs by definition are struggling with their cash management anyway. We found that 36% of SMEs are thinking about their cash management and invoice-based cash flow on a regular basis. It's a huge problem for them. And most of these firms agree, and that's something like 70% of these firms agree, that they would go bust if the cash flow isn't managed effectively. So the cost of being part of such a network and the cost of getting each foreign exchange transfer done is very, very, very high. They struggle with the time of onboarding into the network, and some of the banks take up to 4 months to onboard SMEs and merchants onto their network. And some of the SMEs are denied service, and most of the high street banks actually do not have specific offers for SMEs as well. And once they are onboarded, the time taken to make a transaction, that is significant as well. So the cost and time factors together make a lot of SMEs struggle to survive in this highly competitive market, and that affects not just their profitability but actually the survivability in this market. And also, on the other hand, you have to worry about geographic expansion. When we spoke to these SMEs, we found that 50% of people want to expand abroad, transact with new, emerging, fast-growing markets in Asia and Africa and Latin America, but they're unable to do so because their corporate banks are not letting them do so. They're actively discouraging merchants to go and operate abroad. And that's again due to reasons of the last 10 years and in banking, where they have struggled to keep their operations internationally. And most of the big banks today in the UK, if you look at it, most of the high street banks have pulled out from operations around the world. And this means that the correspondent banking network cost has increased for the banks as well. They have to now partner with regional banks and smaller banks in each country to make the network happen. And it's not effective for anybody. And this cost and time and the struggle for geographic expansion is being passed down to the SMEs and merchants. And that is why they need to look at innovation as a way to keep the relationship stronger with their end customers as well. Unless the banks innovate with new products for SMEs and customers and partner with fintechs possibly to do that. And if the SMEs don't innovate with their products and offerings to their customers, then this market is going to struggle in this highly, highly competitive space.